Welcome to Roadmap to Wealth. My name is Carlos McWhorter, CPA, and my goal is to help you become an informed and successful investor. So maybe you've been investing for a while, or maybe you're brand new to investing and you're just not sure what you're doing. You need some direction. You need to understand what is a good investment versus a bad investment. When is a good time to buy versus when is a good time to sell. This is the goal of my channel, to help you understand these things and to make them as simple as possible. We assume investing is very complicated, but in all of my education and certification and my experience, the most profound thing that I've learned about investing is just how simple it really is. So my goal is to uncomplicate all the things that appear to be complicated and to help you understand how to invest successfully. Now, just a disclaimer, I focus on long-term investing. I don't really focus on short-term trading, charts. I typically stick to the fundamentals, as I've learned that is the best way to understand an investment. When you buy a stock, you have to understand that there is an underlying business that exists that stock represents ownership in. You have to understand the business to understand whether it's a good investment or not. You also have to understand the industry and the position of the business compared to its competitors to know if it's a good investment. So I believe there are 6 factors that identify a quality company. So the goal is to identify quality companies and to make sure that we buy those companies at a fair price or underpriced. Now, many value investors will try to explain to you that it's better to buy a stock that is undervalued, and that may be true, but sometimes value investing is overhyped. Sometimes buying a quality stock and not overpaying for that stock ensures that you'll have some solid gains in the future. So let's talk about the first sign of a quality investment. We're going to focus on the revenues for the first factor. Now, again, I'm going to make this really simple. So when you're investing, the main objective is to grow your money, right? You invest in a stock, you expect that stock to grow or that business to grow, and subsequently the value of your stock to grow. So if that's the goal, then we're going to focus on companies that are actually growing. Yes, there are companies that may be declining or that may be flat, that may be good investments, but why take the risk when there are thousands of companies out there that are growing their revenues year over year? So we're going to focus on those companies. So the second thing about revenues is we're going to identify the growth state of the revenues, right? We're not just going to look at a company that's growing their revenues. We're going to identify whether it is a low, medium, or high growth state of companies. So a low growth state is a company that is growing anywhere from 0 to 10%. And the idea behind this is the market averages 10% per year. So if a business is growing at 10%, it's basically keeping up with the market. So we're not going to consider that special type of growth. So that will be a low growth company. Then we're looking at medium growth companies. Those companies are growing anywhere from 10 to 20%. And then of course, high growth companies. Any company that is growing their revenues 20% or more, we consider high growth. So when we're looking at a company, we identify low, medium, or high growth. And even companies that are declining will effectively put those companies in a declining revenue category. Then we look at the revenue mix of the company. A lot of these companies have revenue sources that are coming from different places. For instance, if we're looking at Apple, we can't just assume that their revenue sources is coming from one place. They have the iPhones, the Mac, they have the iPad, they have wearables, and they also have the services. So a company like Apple has 5 main revenue streams. We need to understand which revenue streams are the more dominant, which ones are growing the most. That way we can see where the company is versus where the company is going as far as the revenue stream. So the next factor in determining if a business is a quality business or not are margins. Margins tells us 2 things. Is the company efficient? And is the company profitable? Now, margins is just another word for profit, right? So we think about gross profit or gross margin, operating profit or operating margins. And those are the 2 margins that we look at, the gross margin and the operating margin. So when you hear margin, you typically are looking at a percentage of the revenues. So to find the margins, we're going to look at the income statement. So the income statement, of course, the top line are the revenues. Right under the revenues are the cost of goods sold. That is all the costs associated with producing the actual product or service that the company sells. What's left over after all the cost of the goods sold is the gross margin or the gross profit. This number lets us know how efficient the company is. Then the second margin is the operating margin. So once we take away the cost of goods sold and we're left with the gross margin, we then look at all the SG&A, or the selling, general, and administrative expenses. So these are the expenses that are associated with running the business that are not directly tied to the actual development of the product or the service that the company sells. What's left is the operating profit or loss, or operating margin. So that lets us know if the company is profitable or not. So gross margins, we're looking at efficiency. Operating margins, we're looking at, does the operations of the company generate a profit? When we're looking at businesses, we're not looking at something that's in a vacuum. With everything that we look at, we always compare to the industry. The margin can't be a good margin or a bad margin in and of itself. It has to be compared to its competitors, so we know how this company measures up to its competition. The second factor in identifying a quality business is looking at the margins, specifically the gross margin letting us know how efficient the company is, and the operating margin letting us know how profitable the company is. Now it's time for the number 3 factor in identifying a quality business, and that is my favorite metric, which is the free cash flow. To identify the free cash flow, we look at the cash flow statement of the business. We take the cash generated from operations and we minus the capital expenditures. Now, why the capital expenditures? The capital expenditures are the required reinvestment in the company to keep the company going. With all businesses, without reinvestment, there is no growth. So all companies have something that they have to reinvest into the business in order to keep it operating and to keep it growing. That is the capital expenditures, the required reinvestment into the company. So we look at the cash generated from operations and we take out the capital expenditures. What's left is the free cash flow. Now the free cash flow is the most important number in a business, in my opinion, because that is the amount of money that is used for acquisitions, reinvestment into the company, buying back shares, and also paying dividends to the shareholders. You want to invest in companies that are free cash flow positive, companies that are growing their cash flows year over year, or at the very least have strong cash flows if those cash flows are not growing. That is what's going to increase the cash balance and make sure that the company can stay out of trouble if they have those cash reserves, or be able to pay down debt, as we'll talk about next. When evaluating a business, I believe the free cash flow is the most important figure that there is. Number one, the free cash flow can be used to assess the profitability or vitality of the business. It can be used to assess if the business has too much debt. It can be used to assess the payout ratio. However much of that free cash flow is being paid out in dividends is the payout ratio. Also, even valuation, you can look at the total market cap of the company compared to free cash flow and get an idea of the valuation of the business. So it gives you an alternative to the PE ratio. So there's so many things you can learn about a company by looking at its free cash flow. That's why it's the most important metric in analyzing a business. So again, free cash flow is the cash from operations, and you subtract the capital expenditures, which is the required investment into a business. What's left is a free cash flow. Now, the fourth factor in identifying a quality business is looking at the balance sheet and making sure that the company has a strong balance sheet. So what is a strong balance sheet? I use the debt to equity ratio. I'm looking at the total long-term debt and I'm comparing that to the equity of the company. A strong balance sheet, in my opinion, is something where the debt is no more than 25% of the equity. 25% and lower, we have a strong balance sheet. The second thing we identify when we're looking at the balance sheet is the company over levered, or is the company leveraged properly? Now by leverage, I mean debt. How much debt does the company have compared to the free cash flow? Ideally, I want a business to be able to pay off its debt within 5 years with its free cash flow. So as long as debt is not over 5 years the amount or 5 times the amount of free cash flow, I believe that company has proper leverage. A company having too much debt is one of the main reasons why companies fail. Every business is going to have hard times. Every business is going to have some headwinds that they have to overcome to be successful. And the company that does not have too much leverage will survive over the company that actually has too much leverage. So before we invest in the business, we want to make sure that it can pay off its debt in a reasonable amount of time. The fifth factor in determining if a business is a quality business or a quality investment is looking at the returns on capital. And to summarize returns on capital, we're looking at the assets of the company and comparing that to the earnings or the profit of the company. This is a very important metric to look at. The reason is, as companies are growing over the years, the returns on capital is what you should expect your investment return to be. So if a business has a 6% return on capital, you should not expect to earn more than 6% on that investment annually. If a company has about 15% return on capital annually, you should expect about 15% as a return on your investment, or your investment to grow at 50% per year. So since we're long-term investors, we want to make sure the returns on capital are very favorable, or at least more than the average return of the market. Like the revenues and like the gross margins, the return on capital is not really an important metric to look at in and of itself. We have to compare that to its competitors. Another reason why this metric is important is it lets you know who has the competitive advantage in the market and who doesn't. The companies with the competitive advantage have higher returns than their competitors. They're able to charge more for the same product, and they're able to control costs better than their competitors. Those are the companies with a true competitive advantage. So again, I like to look at the numbers and the hard facts and allow that to tell me the story of the company as much as possible versus guessing or using my bias or my experience to tell me about the company. Yes, your experience is very important, but the numbers, in my opinion, are much more important than your experience. You can have a great experience with the product, but that doesn't mean that's a great business. It's just a great product. So returns on capital, we're looking at the profits of the company and comparing it to the assets. And we want companies that have higher returns than their competitors, identifying a competitive advantage in the market. So the last factor that we look at when we're trying to identify a quality business is number 6, valuation. Now, my goal when I'm looking at the valuation of the company is to not overpay for the company. I want to either pay a fair price or pay a discount, meaning that the company is undervalued at the time that you buy that stock. Now, I'm not the biggest proponent of sitting around and waiting to find stocks that are deeply discounted, only because I understand that if you don't overpay, if you pay a fair price for a stock and you invest in a company that has high returns on capital and great cash flow generation, you will do well with that investment. So I think sometimes it can be overrated to just sit around and wait on deep discounts. This is why I focus on quality businesses. If you listen to some of the big time hedge fund managers of today, Manish Prabhai, Terry Smith, even Warren Buffett, they will talk more about quality businesses than they do valuation. Of course, they're looking at trying to buy stocks that are undervalued. You know, they want that margin of safety, they want big gains, but they also understand buying and holding quality businesses is the key to long-term investment success. So a quick way to identify if a business is undervalued, fair priced, or overvalued is looking at the PEG ratio, the price earnings growth ratio. Now, Peter Lynch is the great investor that is known for being a proponent of using the PEG ratio to help value a company. So what the PEG ratio is doing is comparing the current price of the company to the earnings potential of the company in the future. So the theory is the PE ratio should equal the earnings growth of the company if the company is fairly priced. If the PE ratio is higher than the earnings growth, you're probably looking at an overpriced stock. Subsequently, if the PE ratio is below the growth of the company, you're probably looking at an underpriced stock. So if the PEG ratio identifies that a stock is either underpriced to fairly priced, we're looking at that as a potential great investment. If the PEG ratio identifies it as overpriced, even though it may be a great company, we do want to wait till that valuation begins to make sense for us because we don't want to overpay for the stock. So those are the 6 factors that I use to identify a quality business. We're evaluating the revenues, the margins, the free cash flow, the balance sheet, higher returns on capital, and we're using the PEG ratio to make sure that the company is properly valued or undervalued before we consider investing in that company. Now, as a wise investor or a smart investor, we want to grow our money, but we want to do it while reducing risk. You cannot eliminate risk with investing. All investing involves assuming some risk. You can't eliminate it, but you can mitigate those risks. So we use these factors to help us mitigate those risks. If a company checks each of those boxes that we discussed, the chances are it's probably a safe investment. You can't predict the future, but you can do the work up front to reduce the risk of losing money in the future. So using these metrics, I at least know that there's a strong chance that this investment that is growing their revenues, has a strong position in the market, great margins, has high returns on capital, can pay off their debt in 5 years, and is not overpriced, there's a great chance that business will give me solid returns in the future at minimal risk. Thanks for joining me today. If this video was helpful to you, please consider hitting the like button and subscribing to my channel. Thank you. This has been Roadmap to Wealth.